In a major relief to Indians who travel abroad for tourism or business purposes, the government today said that transactions through international credit or debit cards up to Rs 7 lakh per financial year won't be included in LRS or liberalized remittance scheme and hence won't attract payment of 20% TCS. The move came after many middle-class Indians, professionals and some very influential names on Twitter expressed unhappiness over the government move to include international credit card spends in LRS. So, while the 20% TCS on large transactions remain, any spend up to Rs 7 lakh per year either through debit or credit card won't attract any TCS. This is indeed a massive relief. People were upset as TCS or tax collected at source means that tax is collected at the time of the spend and it will be adjusted against actual tax that is to be paid by the individual and can be claimed as refund only after the end of the financial year. In effect, this would have made it costlier for people to pay for normal expenses like hiring a taxi, eating out at a restaurant, etc. Now, let us explain what the entire controversy was all about. LRS or Liberalized Remittance Scheme allows all resident Indians to freely remit up to $250,000 every financial year for normal expenses or for purchasing assets, shares, etc. abroad. However, TCS needs to be paid on any expense that is part of LRS. Till now, spending on international credit cards was not part of LRS, while spending on debit cards was included. This made international credit cards a much more attractive option to spend abroad. Now, the Finance Ministry has omitted Rule 7 of the Foreign Exchange Management Current Account Transactions Rules 2000, thus effectively including forex spending through international credit cards under the LRS. Buying overseas tour package has also been included. The other part of the government's move is to hike the rate of TCS to 20% from 5%. This was part of the budget proposal. So, these two steps combine to make life more difficult for Indians who love to travel and spend abroad. Now, the government has said that 20% TCS rule remains but will be applicable only for spends of over Rs 7 lakh per year. So, what does the government say on its initial move to include international credit card expenses in the LRS? The government has basically justified its move on various grounds. It says that bringing credit card spends under LRS was necessary as debit card spends were already part of it. It also says that 20% tax on presumed income of people who are able to travel abroad is not high. Basically, the government says that anybody who can afford to go abroad and spend through credit card will be rich enough to fall in the 20% tax bracket. The government says that several instances have been noticed where LRS payments are disproportionately high compared to disclosed incomes. The government has also reiterated that there is no change in tax implication for those paying for medical treatments or for education abroad. It was 5% earlier and remains so now. It also says that for incidental and travel expenses related to medical treatment and education, TCS remains 5%. A Times online report.